Chapter 4 is the individual income tax overview. We'll do a brief overview of the entire income tax calculation, and then we'll cover each piece in subsequent chapters. So this is kind of the big picture, and there is a lot of information in this chapter, so make sure you're going through it slowly and in detail, and ask if you have any questions. First, we have the gross income calculation. So all sources of income is very broadly defined in our Internal Revenue Code. Section 61A says that income is realized income from whatever source derived. So if you find $20 laying on the floor, that is money that you're supposed to be recognizing as income. We get to subtract any exclusions, so things that the IRS actually says these are not going to be considered income can be excluded. Deferrals are sources of income that are not taxed now but will be taxed in the future. Things like like-kind exchanges, an increase in income in an IRA. It's realized income that will be taxed in a subsequent year. And then that will equal ultimately our gross income, which is all income subject to taxation in the current period. The two primary types or characters of gross income are ordinary income. Examples of that are salaries and wages. Those are taxed at our ordinary rates. So when you think about our tax rate schedule, the brackets and all of that, that's what we mean by ordinary rates. And then we have preferential income, things like qualified dividends and long-term capital gains that are taxed at a preferential rate, so lower than the ordinary tax rate. The qualified dividend tax rate and the long-term capital gain tax rate is 0%, 15%, or 20%, and that depends on your ordinary income tax rate. So we'll talk more about that when we get there. Deductions reduce taxpayers' taxable income. Taxpayers are not allowed to deduct anything unless a specific tax provision allows them to do so. So it's what we talked about earlier. It's a matter of legislative grace. Not all expenses are deductions, and there are two main types. So there's for AGI deductions and from AGI deductions. So if we think about how our process works, the deductions for AGI are deductions that get us to the calculation of AGI. In general, the for AGI deductions are expenses that relate to making money, like business and investing activities, and they will never be reduced. They're referred to as above the line deductions. So these are for AGI deductions because they are used to get us to or calculate AGI. Just a note, as we had this major tax law change recently, there are going to be some times where I point out, this is how we used to do it, and this is what's different. Moving expenses used to be deductible for AGI, but now they're only deductible for members of the armed services. So when you see moving expenses, or if you're looking at tax returns from previous years and previous rules, you may see moving expenses as a for AGI deduction. That's only allowed now, again, for members of the armed services. Because for AGI deductions decrease AGI, they increase deductibility of from AGI deductions that are subject to AGI limitations. So a lot of our deductions are based on AGI. So if your AGI is too high, you lose out on some deductions. So the calculation to get to AGI is important, even for subsequent deductibility that's going to come later. All right, adjusted gross income is our AGI, and it's important for determining a taxpayer's eligibility for certain other tax benefits. Okay, so as I said a second ago, if it's too high, you're going to lose the ability to deduct other things. After we calculate AGI, we have deductions from AGI, and those are the greater of the standard deduction or the itemized deductions, and 2, deduction for qualified business income. From AGI deductions, which include itemized, standard, and qualified business income deduction, in years prior to 2018, from AGI deductions included itemized deductions, the standard deduction, and personal and dependency exemptions. So we no longer have those personal and dependency exemptions anymore, and that's kind of all piled into the standard deduction now. Okay, then we have our itemized deductions. Itemized deductions are related to living expenses, although not every living expense is considered an itemized deduction. So I have some examples here of medical expenses. There are different requirements and rules about each of these elements that we'll talk more about when we get to that section. This itemized deduction is used to encourage certain behaviors. So some itemized deductions can be reduced depending on the level of AGI. You may not be able to deduct all of it, and you have to have support for these in the form of receipts and things like that, in case you were asked to supply those. The standard deduction is an estimate of deductible living expenses. So in 2018, it's $24,000 for married filing jointly. And it's supposed to simplify and say, you know, if you don't want to calculate all of your itemized deductions, you can just use the standard deduction. Taxpayers get to claim as their deduction the larger of the standard or itemized deductions. So, you know, they're making an election every year whether or not they're going to choose the standard or they're going to itemize. And again, that may vary from year to year depending on what their year looks like in terms of itemized deductions. The from AGI deductions also include the deduction for qualified business income. This deduction is allowed in addition to either the standard deduction or the itemized deductions, and it's generally equal to 20% of the taxpayer's qualified business income. This is discussed more in Chapter 6 when we discuss other individual deductions. And it's new beginning in 2018. So this is something that the IRS is still coming out with guidance on how this works exactly, even into tax filing season of 2019 for 2018 year. So we're still learning about this a little bit ourselves as we go. All right, that gives us adjusted gross income minus our from AGI deductions, and that will end up giving us our taxable income. The taxable income is the tax base for calculating our federal income tax. Our tax liability then is our taxable income multiplied by the tax rate from the table. And if you look in schedule, or I believe it's Appendix D in the back of your book, it has all the tables in case you haven't had a chance to look at that yet. So we have after our tax liability plus other taxes. So we have, for example, possibly the alternative minimum tax, taxes imposed on tax basis other than taxable income, and that will give us our total tax liability, which is the amount of tax you owe for the year. We then can subtract any tax credits. So our tax credits are given to encourage certain behaviors, and they reduce taxes paid dollar for dollar. So tax credits are really valuable. They're more valuable than a deduction because the deduction only saves you the marginal tax rate. So if you have a deduction of $1, the value of that deduction is only $1 times your marginal tax rate. Or so if your marginal tax rate's 30%, it's really worth 30 cents. But a tax credit that's $1 saves you $1 in tax liability. So they're very valuable, and we'll get more into tax credits later. All right, we also have tax prepayments. So we can have two main types of prepayments are the federal withholdings. So when you have a paycheck and some of your earnings is withheld from your bank account by your employer, that's withholdings. And then sometimes, depending on how businesses are organized, you can pay estimated tax payments. So if you're a self-employed individual, you aren't going to have your employer taking out your withholdings from your paycheck, and you pay in estimated tax payments throughout the year. It's a similar idea, but that counts towards what you've paid in your tax liability. So your prepayments are going to reduce what you owe now, and then they may actually even be an overpayment. So if you've overpaid because you've had so much withheld or you've prepaid so much in estimated tax payments, then you may get a refund back. All right, so now we have our tax due or refund. And as I said, the refund occurs if the taxpayer has paid too much up front. So, you know, sometimes I have people ask me, oh, am I going to get a refund or am I going to owe? And it really depends on how much has been withheld for you. And so when you're filling out employment paperwork, you can decide, do you want your employer to withhold a lot, and then you're more likely to get the refund? Or do you want your employer to withhold very little, and then you may owe tax at the end of the year? So you have some control over how that works. And you can be charged interest if withholdings or prepayments are below a certain threshold. Okay, so if you haven't done enough, you can be charged interest for that. Also, the taxpayer's filing status affects many aspects of the calculation of the tax formula. It can also depend on whether the taxpayer has dependents. So there are a lot of moving parts here that are going to determine this component of the tax. All right, so kind of in summary, we have our income minus any exclusions or deferrals gives us gross income. We then have 4 AGI deductions, and those are specifically laid out for us. That will give us our AGI. Then we subtract off the from AGI deductions, and there are 2 pieces to that. First is the greater of your standard or itemized deductions, and number 2, the deductions for qualified business income. That gives you your taxable income. Then we can calculate the tax using the tax brackets or the tax rate schedule. We can add in any other taxes that aren't included, like the AMT or self-employment tax. That gives the total tax that we owe. So that's the total tax we owe to the federal government for the year. And then we can subtract off any credits, any prepayments we've made in the form of withholdings or estimated payments. And that will tell us how much we actually have to write a check for now, or how much we would get back as a refund. Okay, so this entire tax formula that we've just gone through in the last couple of slides, let me just flip back, is really very helpful, and it's also the first page of your notes. If you want to think about getting comfortable with this and studying this a lot for the exam, I think that will really help you a lot. All right, so what's new under the 2018 Tax Act? All right, so a couple of main points that I want to make for you. First, changes in deductions. So one is the standard deduction was increased, and it's different under different filing statuses. So let's just look at, single and married filing jointly here. It went from $6,350 to $12,000 for a single person. It went from $12,700 to $24,000 for a married filing jointly person. It also revised standard deductions for dependents. So the greater of $1,050 or $350 plus earned income, not to exceed the standard deduction for those who are not dependents. All right. 3, it eliminated personal dependency exemptions. So previously, for your parents or whoever was claiming a child as a dependent, they would have gotten $4,050 as a deduction, and that it no longer exists. It also created the qualified business income deduction. As I mentioned, there, as of January 1, 2019, when these tax returns are supposed to be filed and worked on, there wasn't complete guidance on how this was going to work. So we can talk more about that when I see you in class. And then it eliminated the moving expense, alimony, and restricted other deductions. Okay, so several different changes under the new tax rules. Changes to the schedule. So tax rates for all but the lowest bracket are lower. Okay, for a given level of taxable income, a taxpayer's liability will be lower in 2018. However, due to the changes in deductions, taxpayers may have higher taxable income in 2018 than 17, and then may end up owing more in taxes. So we can talk more about the nitty-gritty of this in class, but the reality of the reform is that no matter how hard you try, there are winners and losers. And so there was a lot of rhetoric used with the Tax Act. And what my hope is that you guys can analyze what you like, what you don't like, when you have the information and the tools to kind of think about how this impacts people. Also, it doubles the child tax credit to $2,000 in 2018 and creates a $500 tax credit for other dependents. So we'll talk more about changes to each of these in the chapter that we discuss that issue in. All right, there are a couple of examples here, and we're going to wait and talk about these when I see you in class. So we have Janine, a single taxpayer. We'll talk more about that later. And then a couple of other things I want to talk about with the standard versus itemized deductions. Again, we said that the standard deduction is the government's estimate of deductible living expenses. So for a single person, it's 12. For married filing jointly, it's 24. The dependent is greater of 1,050 or 350 plus earned income not to exceed the standard deduction for those who are not dependents. And the standard deduction increases if the individual is over 65 or blind, or a single head of household, it's $1,600 for each, and married filing jointly, it's $1,300 for each. So if you're an individual who is over 65 or blind, these are the additional standard deductions you would get under those circumstances. And the deduction for blindness was created in 1940 for blind veterans, which was a common injury at that time. So, you know, the tax law is the way it is because of, you know, what was going on at the time the laws were modified. All right, so we would claim either the standard deduction or the itemized deductions. And again, if you want the larger one because it's reducing your taxable income, and you have to have backup for your itemized deductions. So when people say they have like a shoebox of stuff they're going to give their accountant, this is usually what they're talking about. This is the shoebox full of all of my, you know, receipts for going to the doctor or whatever else is in there. This is what they're referring to with that. We have an example here of the standard versus itemized deductions that we will get into when I see you in class, and then we'll keep going. All right, the dependence of the taxpayer. Prior to 2018, taxpayers were allowed to claim personal exemptions for themselves, which was one per person, and dependency exemptions for their dependents, one per dependent. For 2017, that was a $4,050 exemption. Beginning in 2018, personal and dependency exemptions are no longer allowed, but we still need to be able to determine whether there are dependents in order to determine filing status, eligibility for certain tax credits, and other calculations. So we still need to do this analysis, even though we aren't doing the dependency exemption like we've done in the past. The requirements to claim an individual as a dependent there are 3 of them that apply to any dependent. First, you have to be a resident of the US, Canada, or Mexico. The dependent does. The dependent must not file a joint return with the spouse unless there is no tax liability. And 3, the dependent must be considered either a qualifying child or a qualifying relative. We'll talk about those 2 designations next. A qualifying child has 4 tests, and to be a qualifying child, the child must meet all 4 of these tests. So we have the relationship test, age, residency, and support. So first we'll talk about the relationship test. The qualifying child must be an eligible relative, and of the taxpayer. That includes a child or a descendant of a child, a sibling or a descendant of a sibling. So you can think about a relative being a son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of those. And it must be a direct relative, meaning that cousins don't count. Anyone at your level of the family tree or below. The age test. The qualifying child must be younger than the taxpayer and either under 19 years of age at the end of the year or under 24 years of age at the end of the year and a full-time student. An individual who is permanently and totally disabled is deemed to have met the age test. Older siblings cannot qualify as a dependent as a qualifying child. So again, it says you have to be younger than the taxpayer. So an older sibling of yours would not count. For the full-time student eligibility, it says in either the spring or fall to be a full-time student for the whole year. So any part of 5 calendar months you've been a full-time student. The word permanently and permanently disabled can be made on a year-by-year basis, and disabled can be mentally or physically. So this gets into some really nitty-gritty details on what the law means for each of these words. Permanently disabled is deemed to have met the age test regardless of age. So again, you can be 30 and be permanently and totally disabled and meet the age test. All right, the residency test. The dependent must have the same principal residence as the taxpayer for more than half the year. The year of birth and death count as a full year. And there's an exception to this rule if the child is away for education, military service, illness, or work. It's deemed that while you're away for those temporary things, that you're treated as if you're living in the home during that time. All right, the support test for a qualifying child. The child must not have provided more than half of his or her own support during the year. Scholarships are excluded from the support calculation. The tax law considers who provided the support, not how much income the child earns. So if the parent pays the majority of the child's expenses, the support test is met even if the child earns a lot of money. So you can think of a child star. They may make a lot of money, but they will pass the relationship and age test, and if they live with their parents when not on set or touring, and if their parents pay their insurance, food, or whatever else, regardless of how much money that child makes, the child is classified as a qualifying child. All right, there are tie-breaking rules that the textbook talks about, and those tend to come into play with parents who are split up and who gets to claim the child. If parents are divorced, only one parent would be able to have the child as a dependent. We're going to skip through the tie-breaking rules. All right, we have the example of the qualifying child for Richard and Connie. We're going to talk about this when I see you in class. And we're going to move on to the qualifying relative test. So a qualifying relative is a person who is not a qualifying child and meets all 3 of these following tests. So the relationship test, the support test, and the gross income test. Realistically, this was put into place for people who were taking care of their elderly relatives, and it wouldn't have worked as a qualifying child. All right, the relationship test for a qualifying relative is the person must be a relative, which is defined more broadly here. So this is a descendant or ancestor of the taxpayer, siblings, or relatives through marriage. Any relative by marriage or blood can qualify without living with the taxpayer. And a member of the household has to live with the taxpayer for the entire year. So either they can be related, which is in bullet point 1 here, or they can be a member of the household and not related, as long as they live with the taxpayer for the entire year. All right, the support test. The taxpayer must pay for more than half of the qualifying relative's living expenses. Scholarships are excluded from this calculation, and we're going to ignore multiple support agreements. So that's where we have typically children chipping in to cover the support of an elderly parent. We're going to ignore that for this class. And then the gross income test. The qualifying relative's gross income from the year has to be less than $4,150 in 2018. The amount is equal to what the personal dependency exemption would have been, although we don't have that anymore. And then gross income is subject to tax, so tax-exempt income does not count towards this. Okay, so tax-exempt income does not count. We have another example here with Becky and Lisa. We'll go through this together. And we have a couple of differences between the qualifying child and qualifying relative test that I just want to go through quickly. First, the relationship test is broader under the qualifying relative rules. So more people would count as a relative under the qualifying relative status. The qualifying child status is more narrow. Number 2, qualifying children are subject to age restrictions where qualifying relatives are not. 3, qualifying relatives are subject to a gross income restriction, but qualifying children are not. And 4, taxpayers must provide more than half the support for the qualifying relative, but not for the qualifying child. Number 5, qualifying children are subject to the residence test, but qualifying relatives are not. Okay, so if you think about why these were created, trying to help people who were, in different situations with taking care of family members or things like that, that's why the rules are what they are. Any individual who is a dependent of another taxpayer is not allowed to claim any dependents. Okay, so if you're a dependent on your parents' return, you cannot claim any dependents. All right, I have another example here that we'll go over together. So you have one with Marcy that we'll talk about, one with Katie that we'll talk about in lab or in class together. And then I want to get to filing status. So taxpayers determine their filing status according to their marital status and whether or not they have any dependents. It's important because the filing status determines the tax rate schedule, so the brackets and what tax rate schedule they're going to use. It also determines the amount of the standard deduction and eligibility for certain deductions and credits. The filing status is determined as of December 31st. All right, we're going to look at primarily single and married filing jointly. And again, those tax brackets are in Appendix D of your textbook if you want to look at the differences. All right, single is a person who's unmarried at the end of the tax year and doesn't qualify as head of household. Married filing jointly is someone who's married as of the last day of the year and the spouse agrees to file a joint return. The income and deductions for those two people are then combined. Married filing separately is when you're married at the end of the tax year and spouses choose not to file a joint return. Most of the time, this is not financially beneficial to you. The reason people do this is for non-tax reasons. Typically what happens is when you're married filing jointly, you're both on the hook for the entire tax bill and you're both basically attesting to the fact that this is correct. And if your spouse then runs off and turns out was lying about everything, you would be responsible. And so people who are married filing separately are people who maybe don't want to be liable for what their spouse is putting on the tax return. Also people who are going through like a separation, they're starting to divide assets, might look at filing separately. But it's not because it's tax advantageous to do so. And then the qualifying widower or widow status, also called surviving spouse, is available for people who've had their spouse die. In the year of death, married filing jointly is what is filed regardless of whether or not there are dependents. And then eligibility to be a qualifying widow, we have to have the person remain unmarried and pay over half the cost of providing a home for a dependent child or stepchild for the entire year. The third year following the year of death, so in the year of death, you'd file married filing jointly. The next 2 years, you'd file as a qualifying widower or surviving spouse. Those mean the same thing. And then the third year, you're eligible to file as a head of household if the child is still living at home. So we'll talk about what head of household means. It's an unmarried taxpayer as of the end of the year who pays more than half the costs of keeping up a home for the year and has one of the following people living with them. They have a qualifying child or a person that qualifies as a dependent and is related to the taxpayer. There's an exception to this, and that's that parents don't have to live with the taxpayer. Okay, so if the person you're claiming as a dependent is your parent, the parent doesn't have to live with the taxpayer. All right, we're going to end here, and I want you to skip the abandoned spouse rules. All right, so we're going to stop here with these main classifications.